what's the first question someone should ask when they get into payments? And actually, is there like a question that everybody asks you that's the wrong question when they get started?
Yeah, I'll start there. The question that I get asked that is like the wrong question, which is, which payment provider should I use?
I think I asked you that.
I don't remember that. It's not where you start. It is probably, is it important? 100% it's important. But it's maybe the third or fourth question or the fifth question. It's not where you start. Do we have the right to win in payments? It's the first question. And then the second is, do we have the appetite and capacity to invest to win in payments? They're the questions that people should be asking before they start.
Is this thing on?
Yesterday's price is not today's price.
Payments. People are just so greedy these days. It's all they ask me about. But seriously, if you're thinking about adding payments to your tech stack, if you're thinking about going all in on that swipey swipe, I've got an expert for you, Andrew Mosawi. He's a friend that I met through JMI Equity Partners, and he's taught me basically everything I know about adding payments to a software product. He has scaled and exited multiple companies within the space, and there are like 50 payment providers today. But he takes us back to when he first got involved in the payment space and what that ecosystem looked like and what you had to do if you wanted to run on your own rails or somebody else's rails. Now he's an advisor for a number of companies with payment products. He takes us through why even bother, like with everything that's going on with AI, what the size of the payments opportunity is, what the non-quantitative benefits are, hint, hint, churn and retention, and what does embedded payments like actually mean. I'll ask the stupid questions for you so you don't have to. And by the way, payments are not a feature. It's an entire way that you have to run the company. So this is perhaps the most signal per minute we've had on like a strategic playbook for adding something to your stack. So tune in if you're thinking about adding payments or if you already have and want to improve it. All this and much, much more after a short word from our sponsors. So if you listen to this podcast, you'll know that I am incredibly passionate about the FP&A space because that's the route I went to get to CFO. And I want to tell you about a tool that has exploded over the past few years. It's called Aleph. And I remember getting outbounded by them about 2.5 years ago, and I actually took the bait because they claimed to be able to do a demo with my live data, with me right there on the call. And so I had to see it to believe it. And it was the founder running demos back then. Shout out Albert, hope you're listening. And he connected my NetSuite and built my P&L using their Excel add-in in like 15 minutes. And I was really impressed. Since then, Aleph has gone on to raise money from some of the top VCs out there, and they've built an impressive roster of customers. Many of their customers have been on the podcast, like the CFO at Turo, 8 Sleep, and Zapier. They're all really big champions and supporters of Aleph like me. But it's not just an Excel add-in. Aleph also allows finance teams to work with their live cross-system data using Google Sheets and their web app. And that's cool because it gives teams the option to support a wide range of needs and workflows like budgeting, forecasting, and variance analysis. And speaking of variance analysis, they're doing some really cool things with AI-powered variance analysis. It basically allows you to figure out what's going on and why, and it takes the time that you'd usually spend from hours to minutes. It's really cool. So I highly recommend checking them out and taking them up on that demo or trial, just like I did back in the day. And you can learn more and get started at getaleph.com/run. That is getaleph.com, aleph.com/run. Tell them CJ sent you. All right, I got to get up on my soapbox for a sec here. Everybody's talking about AI powered this and automated that. But here's the thing about revenue recognition. It's not just about moving data around. It's about getting it right, full stop. So RightRev is laser focused on one thing, RevRec that auditors actually trust. See, there's a difference between automating revenue processes and automating revenue recognition correctly. RightRev was actually built by the godfather of RevRec, who understands ASC 606 compliance, audit controls, data validation, and the flexibility needed for complex B2B contracts. We're not trying to be your billing system or your ERP. We're the revenue recognition engine that sits between your contracts and your financials, making sure every dollar is recognized correctly, on time, every time. Companies like Snowflake and Logic Monitor don't just need fast revenue reporting, they need revenue reporting that's audit ready from day one. And that's honestly where RightRev shines. And what I love about RightRev is they're not out there trying to be everything to everyone and just slap some, AI slop on top of it. While everyone is building these massive platforms that do everything in a kind of mediocre fashion, RightRev does one thing exceptionally well. They make sure your revenue recognition is bulletproof. Ready to stop gambling with your RevRec? Visit RightRev.com to see how we make complex revenue simple. That's RightRev.com, where revenue recognition actually works. This episode of Run the Numbers is brought to you by Navan, the all-in-one travel and expense solution. CFOs and finance leaders, let's be honest here. Your T&E process is broken. Manual reconciliations waste valuable time, policy violations drain money, and limited visibility creates unnecessary risk. Nobody likes that. Navan cuts through these problems, giving finance teams the clarity and control needed to close with confidence, faster and with fewer headaches. Connect your existing eligible Visa, MasterCard, or American Express cards directly to Navan and keep all your card rewards and banking relationships. Get real-time expense tracking, automated policy enforcement, and AI-powered reconciliation that works. Companies like Anthropic, Unilever, and Zoom trust Navan to manage travel spend smarter and increase compliance. Are you ready to modernize your T&E process? Visit navan.com/runthenumbers for your demo today. That's navan.com/runthenumbers. Tell them CJ sent you. They'll hook you up. Andrew, my friend, welcome to the Run the Numbers podcast.
CJ, it's good to be here. Nice to see you again, and thanks for inviting me.
Thanks for letting me drag you onto this thing. I know you're a popular guy. I know you like to be behind the scenes, but we got to give the people what we want. We got to educate them on payments today.
That's very kind of you to say so. Yes, you're right. I don't do many of these, but when I do them, I'm selective, and you're a difficult man to say no to.
I had to pull some strings with the higher ups and the payments gods, and so I want to rewind the clock, because payments, it's like the soup du jour. It's everybody's talking about it today, but you've been in and around the space for a while. What was it like when you started to get involved in payments? What was the ecosystem like?
Yeah, sure. So as you say, I'm a dinosaur in the world of embedded payments. So
a legend, not a dinosaur.
That's very kind of you. I'll stick with dinosaur. So when I first started was back in the early 2000s. And so my background is embedded payments. I don't come from like sort of legacy payment providers like, sort of the banks or the acquirers. I'm actually sort of started out in the integrated payment world, and I kind of backed into it. So back in early 2000s, I'd emigrated to Canada looking for a job, and essentially couldn't find one. So joined essentially it was founding team of the startup that was providing payment processing services, but it was actually direct sales. And so started to go out and work out how we could actually scale that in what was, we decided, the nonprofit and education space. And I'm, trying to find the easy way to do things and not the hard way to do things. Call that laziness or innovation, whichever. And so I realized that actually trying to sell payment processing to multiple different, nonprofits is just very difficult, and it's a difficult game. So decided to actually go to the source and see if we could actually embed our payment processing service into the software companies, and that's what we did. And it was just good. The timing was excellent. It was luck over judgment. And, the business, IATS, it actually became the largest donation processor in the nonprofit industry for the longest time. We integrated into almost every single software provider. And this is probably, 5, 6, 7 years before the likes of Stripe and other integrated payment providers came out there. So we were, it was, we were one of the first, the pioneers, and you could say. And it was funny because no one was in payments at the time. I'd go to conferences and I'd be the only payment provider in the room. Now you go and it's like, people are getting 5, 10, 20 calls a week from payment providers trying to get your business if you're a software company. So it's changed. It's nice. It's come into fashion, shall we say, in the years since I started.
It's come into fashion, and we're going to get into like the nitty gritty, and I'm going to ask a bunch of stupid questions about how payments work. But what do you think was the inflection point? Did Stripe make it cool? Because like you said, you were around before Stripe and Adyen, which I kind of feel like brought payments into the mainstream.
Yeah, I think it was the rise of vertical SaaS, B2B, just the explosion of very tailored solutions that were B2B solutions that were really looking for ways to actually improve their scope and feature set. And payments, I'm sure we're going to talk about this. It has various different benefits if you're a software business. Obviously, there's revenue, but there are many more. And so I think that there was a realization that actually bringing that experience in-house and finding a way to improve the customer journey, that was really where people started to see the value of it. And I think that was it. Of course, yeah, more companies out there like Stripe and Adyen and the many others that have come since then, and specifically pay-fat providers. At the time it was Payrix and Finix and Infiniset, and now there's Rainforest and Precision, and I could take up the next hour going through all of the others. But yeah, there's a better served space, and it's something that is certainly coming into its own as more software companies and investors of software companies realize the value.
So let's set the scene to today. In 2025, how big is the size of the pie here for payments?
It is difficult on a macro scale. BCG have done some reports. I mean, but I can tell you on a very sort of micro scale, it's like a very real practical terms, is that, I'm working with software companies, and then just to give your listeners some context, through my work with my last business and now doing some, advisory work for some growth equity investment firm, I've worked with probably hundreds and hundreds of software companies. And so I kind of sort of real practical knowledge of what they've done. And, I'm seeing companies that have done no payments 5 years ago, 3 years ago, they were doing zero payments. They were just pure, they were software business. And now it's making up 30, 40, 50% of their overall revenue. And these are growth software businesses. These are rule of 40, rule of 50 businesses that are growing year on year. And so just the sheer opportunity for these businesses is quite, it moves the needle. There's no question. But yeah, it's tens of billions of dollars. And of course, payments is the beginning. And again, I'm sure we're going to talk about this, but we're folks like myself that have been around a while realize that actually payments is the first level on the stack, if you like. And once you've accomplished that and you've earned the right in payments, then really there's no limit. Then you can just layer on all of these additional financial services that your customers are going to gain value out of.
And I'm not here to say a company should or shouldn't do payments, but there probably are some companies out there who are looking at their product roadmap and there's so much going on with AI right now. Where do I put the next incremental dollar? It sounds like you should still consider payments as like a pretty viable on-ramp for new revenue.
Yeah. So I guess my contrarian view here is I will test people. I will test companies, appetite and ability to actually set payments up for success. Because first of all, not every company should do payments. I mean, if you're a B2B SaaS company, if you're in that business, there are some companies out there that just shouldn't be in the payment flow. They just don't. It doesn't provide value. So there's no point trying to insert yourself in the process. So I think the first thing to understand is, right, well, is there value? Am I adding value to our customers by actually providing the service? And so I think once you've gone through the diligence, that to me that's the first thing. I think once you've done that, you then almost have to fast forward to an end state and say, okay, fine. So if indeed, and I'm going to give you some examples. Yeah. Let's say your practice management, and these are very real world examples for me, practice management in like allied health, which would be physiotherapists, chiropractors, massage therapists, mental health practitioners. Excuse me. There's clearly a need there for the customers of your customers. So your clients, however you want to call them, the people that are going in for a physio appointment, they have to pay for that appointment. So it's clear then that almost every single one of your practices has the capacity to process a payment, and therefore is going to provide value because it's going to be better if it's in your system than it's in a little point of sale machine on a receptionist's desk somewhere. And so you can just do a back of the napkin math and work out, well, what that looks like in 3 to 5 years, and then say, actually, you know what? This is an X dollar opportunity, and I'm happy to run through some numbers with you just to kind of give your audience a sort of how to think about, to swag what that could look like. But it becomes a very big number very, very quickly. And that allows you to then balance that against other activities and projects. Because frankly, If you don't invest in it, if you don't give it the mind share, if you don't give it the focus, you're not setting it up for success. And then you're just going to deploy it. It's not going to work. And you're going to think, wow, payments never worked for us. Well, is it payments didn't work for you, or is it it wasn't actually set up for success?
All right. So let's have some fun here. We'll pick a lane and see where it takes us.
Okay.
What makes a company well positioned to offer payments?
So I start with the customer journey and the customer experience. So not the software company, their customers. And so I just literally, I would run the company through a map and explain, like a customer journey map and say, right, well, how is that? First of all, is the customer processing a payment? So if you are, I'm picking an example here, if you're a data analytics platform, then if your customer is a data analyst, then it's not likely that they're not going to be processing a payment, as one example. So I would look at it and say, right, well, how are your customers processing payments? Is that how they run their business? Mm-hmm. Is your software where they go to help run their business? And then how are they currently doing it? And, in all likelihood, there's a variety of ways that they're doing it. And most of them are probably going to be quite inefficient if they're doing it outside of your platform, which is frankly where they go to run their business. So follow the money in a real term, which is follow your customers, how they manage their business, how they process transactions, whether that's credit card checks, ACH, doesn't matter what it is. And then using that, you reverse engineer whether or not your solution has the right to own that transaction and whether or not you're those flow of funds. I think it's just an exercise. And once you've done that, then you can start to build out, you can build a model.
Hey, thanks for listening. We'll be right back after a word from our sponsors. Morgan Stanley recently said NetSuite is under the threat of disruption. That's right, NetSuite, you never get fired for buying its software. So, what's the threat? The answer, Rillet. Rillet is the AI native ERP modern finance teams are switching to because it's faster, simpler, and 100% built for how teams operate today. It doesn't take 12 months to implement. It doesn't feel like filing taxes to use, and your accounting team will actually love it. PostScript closes the books in only 3 days. Windsurf, bet you heard of them. They run finance with just 2 people. And Rillet is backed by Sequoia Capital. Yes, that's Sequoia. Unicorns like PostScript and Windsurf and hundreds of other companies have made the switch, and they're closing books in record time. If I were running a finance team today, I wouldn't default to legacy. I'd look at what's coming next, and Rillet is here. You don't want to be that guy at cocktail parties complaining about how bad his ERP is. Wait, am I the only guy who talks about ERPs around a keg? See how fast your team can move. Book a demo at rillet.com/metrics. That's RILLET.com/metrics. RILLET.com/metrics. As a CFO, you're expected to bring clarity to everything, including how your company manages ownership. The tools you use should make that easier, not harder. But when they come with hidden fees, data you can't always trust, and support you can't rely on, you end up with more frustration than clarity. That's where Pulley comes in. Pulley is the cap table management platform built for finance leaders who need accurate, decision-ready data from a system that works for your business, not against it. With Pulley, you get intuitive workflows, audit-ready reporting, and support you can count on, all backed by predictable pricing you can plan around, so you can stay compliant and make smarter decisions about your company's future. Manage everything from fundraise modeling to ASC 718 reporting to custom liquidity programs, all on one trusted platform. Hundreds of high-growth companies like Linear, Fathom, and Runway trust Pulley to help turn ownership into a strategic advantage, and joining them is now easier than ever. You can switch to Pulley in as little as 5 days, and for a limited time, they're offering 25% off your first year. To claim your exclusive offer, visit pulley.com/mostlymetrics. That is pulley.com/mostlymetrics. Pulley.com/mostlymetrics. Well, if you've listened to this podcast before, you definitely know that I think it's cool to be a fan of business. I'm obsessed with researching how the best companies operate and specifically how they manage their money. And I've learned that a company's financial stack can make the difference between world domination and obscurity. That's why I want to tell you about Brex, because I want you to rule the world. Brex is an impressive financial services and software company that has grown immensely since it was founded in 2017. In just the last year alone, Brex accelerated customer acquisition by 50%, with 91% growth in enterprise customers. And there's good reason that over 30,000 companies from startups to enterprises have flocked to Brex. Brex offers the world's smartest corporate card on a full-stack global platform that is everything CFOs need to manage their finances on an elite level. Plus, they offer modern banking and treasury, as well as intuitive expenses and accounting automation, bill pay, and travel. Wow, it's all on the roster whenever you need it. Brex grows with you. CFOs tell me all the time that Brex makes it easy to control spend before it happens, automate annoying tasks, and optimize their finances. Because listen, at the end of the day, Brex helps them make every dollar count. So if you're a fan of smart businesses too, check out Brex at brex.com/metrics. That's brex.com/metrics. We spoke with Peter Benavides, CFO of Olo. So they're a publicly traded company, for the benefit of listeners, in like the quick serve restaurant space. So they offer like a standardized app if you want to order from, I don't know, maybe it's like a Bojangles or a Chipotle. I don't know if those are the actual restaurants on the app, so don't hold me to it. But basically, they give you the ability to have this consistent front end, and you can pay for your food through it. He explained that they had what was like the strategic high ground in order to offer payments that not all companies would have if you look at like what their offerings are.
Yeah, that's absolutely true. And I think that, you can use another example, which is very true to my own heart in the nonprofit space, is that if you are a nonprofit and you have a donor management system, and your donor management system provides an online donation page or peer-to-peer fundraising, whatever it is, then it's pretty logical that the nonprofit is going to want to use you to manage all of their payments. Now, they don't, by the way. Before we started automating everything, they would have like Excel documents with credit card information in that they would then kind of go to a terminal and actually plug in numbers every single month for recurring donations. I mean,
oh my goodness, physically they'd have to go to the terminal and enter it in?
That's actually how our business started. Was actually we actually received our annual receipt from a charity, and it had 12 point of sale receipts stapled to the annual gift receipt. And so that was the spark for us to say, actually, that's nuts. We can improve that, and we can automate it. So actually, that was the seed of how our business started. So yeah, it does. That's exactly how it works. And so I think also some companies, they operate in higher, like restaurants are very high, low margin. They're very commodity driven. It's a very aggressive competitive space. So it really depends on what space you're in. But I think what's interesting to me is that what we know consistently is that software companies that embed payments into their solution almost always have better retention, lower churn than companies that don't. And so I've even done this within companies that I'm involved in, where we've done an analysis of all of their software, all of their customers who have payments and who do not have payments attached. And because, of course, you never get 100%. It's very rare that you get 100% adoption amongst your client base. So it's a good way to map it out. And almost always we're seeing that retention is significantly higher when payments is attached than when it isn't. So we know, there's a couple of things that we know from that. And one of which is that the customers they're extracting more value from your overall solution, and they're less likely to leave because of the payment element, because they're not having to go out of the system to manage those transactions.
Andrew, this might be a stupid question, but does that inherently make winning the payments business harder? Because it's not like you just like rip out your payment processor, even if it sucks like willy-nilly overnight.
Oh yeah, it is. So payments is notoriously sticky. And so actually in my business, it's been several years since I sold the business, but we actually did an analysis of the average life of a payment customer. If you're direct with any of the big ones, so think Fiserv, WorldPay, Global, they're all pretty much the same now. But if you look at them, it's like, I think it's less than 2 years. You stay with the payment processor less than 2 years.
That's it?
That's it. If you are an embedded payment, my business, it was about 8 years, 7 to 8 years, our software companies and our merchants, because they're stickier. They actually don't want to leave because they're extracting more value. It's not a commodity. It's not just ripping out a point of sale machine. It's a lot more. There's a lot more. You can call it stickiness. You can call it value, depending on where you come from. But yeah, it's sizable, the difference that it makes if you're embedding payments. Now, counter to that, CJ, let me say, is that you could also say there's an argument that is it because it's another solution it's a bolt-on solution, a Accretive solution to your software, And is there an element of that to it? Yeah, maybe. Maybe if you added another module or feature or set, then that may also improve churn. But to the extent that I've seen a lot of data across a lot of different companies, all evidence leads to the fact that adding payments, embedded payments, and I'm saying embedded specifically, as opposed to just a referral arrangement, then it significantly reduces churn.
I want to pull the string there. So can you unpack what embedded payments means?
So it's the function of integrating the payment process in your software so the user doesn't essentially have to go somewhere else to process the transaction.
So you're in the workflow that they were already in,
without them having to go anywhere else. And in most cases, without them even realizing that somebody else is actually facilitating the processing of the transaction. As in, if you are a software company, your users believe that you are the ones that are actually processing, and then settling the money into their bank account or their customer's bank account, as opposed to Stripe, Adyen, whoever else. It's a completely embedded solution.
How often than not are you actually the one doing that? Like that's a pretty big jump to make on that, like Maslow's hierarchy of payments or whatever you want to call it, right? Like it usually is, would you call it white labeled? What would you call it?
So this is where us payment people, CJ, we love our acronyms. We love overcomplicating what really should be very simple. So you'll hear these terms like ISO, referral, PayFac, PayFac as a service. Basically, all of those things mean that you as a software company, you're not actually physically connecting to the acquirer or Visa, American Express. You're not using it. You're essentially, you're front-ending to a PSP, a payment service provider like Stripe, Adyen, Rainforest, whoever it is that you're choosing to use. And so it is very rare. In fact, in my life, I don't really think I've come across many, if any, software companies that are actually dispensing going down that route and then having a direct pipe to the credit card companies or a sponsor bank. You have to be very, very large for that to make sense financially with the investment that's required to do it.
Okay.
And again, what do I mean by very large? So I will regularly talk and I work with organizations that are doing upwards of $5, $6, $7 billion of gross processing on an annual basis, and it still doesn't make sense for them to do it. So when I say big, I mean even much bigger than that.
And why is that? Is it the technical complexity, or is it the risk that you have to underwrite that makes it not a great proposition until you're $1 bazillion?
It's actually just all the infrastructure that you would need to do. So you actually, yes, there's underwriting, but then there's also the direct integrations to the card brands. There's just the level of complexity to actually essentially become your own payment processor. It's not undoable. It's not, you can't do it. It just becomes the ROI just doesn't really make sense for what potentially could be 3 to 5 to 6, basis points of additional net margin. So, and at the end of the day, what business are you in? Well, most of the people I talk to are in the business of software. They're not in the business of trying to set up a payment processor.
That makes a lot of sense. I want to pick another lane to travel down and see where it takes us. Let's go down the road of like, what are these models? You threw around, I think ISO, you threw around PayFac. Break down what the different flavors are. So
like the very kind of the entry point of a payment would be a referral arrangement. So that's when you have a customer that needs to process a transaction. You say, okay, yeah, we have this relationship with this payment processor. Go and talk to them, and they'll set you up with an account, and then they'll get you started. So really, it's a hands-off, arm's length relationship, and that payment provider will kick you over some money at the end of every single month, and it's usually not a lot, but it is equal to the kind of work effort that you're putting into it. So that's the first step, and then there's ISO, which is not really a regularly seen thing anymore in the embedded space, which is just an independent sales organization. So most of the people that are out there that are selling merchant services, they're independent sales agents. So they're ISO, independent sales officers. So they're actually out there selling merchant accounts on behalf of somebody else. That could be WorldPay. It could be a number, Chase, JP Morgan, whoever. That's the traditional method of kind of issuing MIDs, merchant accounts, and the way that the payment business has started. Interestingly enough, in the last 5 years, more MIDs, merchant accounts, were issued through software companies and embedded platforms then were issued by banks and the old way. So it's like very quickly, it's kind of skyrocketed that. So PayFac, all that means is a payment facilitator. And it means that you are essentially acting as a facilitator of transactions for your customers. And so that comes in many different flavors. But essentially what it means is that if you are a true PayFac, you actually have to register with the card brands. You have to get PCI level 1 compliance. There's a whole list of things to do. What's more normal is what has been called PayFac as a service. And that's really where folks like Stripe and Adyen and Precision and Rainforest, and again, I could take the rest of the hour doing them. These are the ones that they've set up, which is it's an entry level way for a software company to come in, integrate the payment workflow into their system without actually having to do any of the heavy lifting, without having to do any, register with the card brands. Obviously, there will be some levels of PCI scope that you have to deal with depending on your volume. And then you're good to go. Essentially, what's going to happen is, depending on the way that you negotiate your contract with this provider, either you take on the risk or they'll take on the risk. Either you have to do the underwriting or they'll do the underwriting. Either you have to build the onboarding flow or they'll have to build So there's all of these puts and takes that you decide in the process that will actually determine how much money you're going to make out of it and what your commercial deal looks like. Because obviously, the more you ask them to take on, then the lower your residual or your revenue is going to be, your take rates are going to be.
I want to touch on the take rate bit in a second, but it's interesting how you said, like, how much do you want this to look like your UI and your UX? How much do you want this to look like you built it and they can't really tell the difference? That actually is a pretty big consideration for companies, isn't it?
It is. It's part of that journey, is that you don't want to inhibit the startup the onboarding of that customer. So there's a little bit of tension there, because you are giving customers credit and you are actually underwriting them for credit. It's a credit card processing. So you are going to have to do KYC and KYB, and you're going to have to actually make sure that it's not a fraudulent, illegitimate customer. So all of these things that have to happen. But of course, the balance is that you just want them to sign off your software.
Right.
And so there's this kind of quid pro quo that you have to go through to balance things out. But at the end of the day, you can't get away with it. You have to do it. You have to do KYC, KYB, especially, and most of these processes will do it for you because they have to. So I think to make that onboarding journey the simplest and the most clean is the goal of most people getting into payments, because they want to make it seamless and easy and quick.
There's this inherent friction that you want to get them on board as fast as possible, but you also want to make sure that they are who they say they are and they're good for the money.
100%. And that's there's many different types of fraud in this business, but a merchant fraud, which is what you're talking about, which is where somebody comes along and pretends to be somebody else in order to kind of run, it's like, stolen credit cards, whatever. That's obviously the thing that everyone in our business worries most about. So making sure that, you're checking on who they are up front is incredibly important. And I have to say, there are some super cool businesses out now using AI to do that in a incredibly effective, scalable way.
So let's follow the money. You mentioned rev share. Well, what's like a typical take rate that you can get on this?
Okay. CJ, you're going to hate this answer. It's going to be a big ban.
I feel like you're going to say the D word, depends.
No, I'm not going to say that now. I'll change my answer. So, there's a lot of things in flux here. So I'll just give you the number, is that you can expect anything depending from, like, say, 25 basis points all the way to 100, but more likely 80 basis points, 90 basis points, depending on how you decide to do things. If you're okay taking the risk, if you're okay, bringing everything on yourself, as in managing customer service, managing queries, taking on the risk, doing the underwriting, and you have a forecast where you're going to do significant volumes and you can negotiate a good deal, you are going to be the upper end of that. Here's the thing, though, CJ, you've got to think through, which is also, it depends on, like, the elasticity of pricing. So what you sell to your merchant at, because you are going to be setting the merchant rates. Payment provider is not going to set it. You're going to set it. And you may be in a sector, a good example is, like you just said, retail or restaurants. Very aggressive margins, because it's a high volume business. You don't have as much ability to increase prices to glean a higher take rate than perhaps another sector where there's less price sensitivity. And so, somebody can get away with charging 3%, whereas it's highly unlikely that you would be able to charge that to an enterprise merchant in the retail space, as an example. So that being said, that's what it looks like. You're going to take that spread depending on how much risk and the negotiation. So what I think is interesting is that think about the numbers and you think 80 basis points. Why do I care about that? It's like, who cares? I mean, 80 basis points? That doesn't seem exciting. Well, if you break it out with an SMB business, just as an example, like the average SMB payment business is usually doing, let's say, $250,000. So you're doing $250,000 a year of sales, let's call it, on average across that. And let's say you have 1,000 customers on your platform that are using payments. Well, that's a $2 million net revenue business right there. So the way that works out is that very quickly it scales because those customers are always processing. They're just going to continue processing and you're just going to add to that. And I guess I should explain how I got to that number.
Yeah. I'm trying to do the math. Let's do it.
If you're doing 250,000 multiplied by 1,000 merchants, that gives you the number. But here's where it all breaks down. First of all, you have to pay interchange on that. And so that goes to the card brands. And that is very dependent on what kind of card it is. Because if it's an American Express Platinum card, it costs a lot more than a green card. If it's a Infinity Visa card, it is a lot more expensive than, just a free Visa card that is given away by a bank. So depending on the card type, depending on the type of transaction, if it's an online transaction, we call a card not present, or a retail, like a card present, that's, again, lower risk with a card present because it's less likely the person has actually been physically stolen the card. So it's a lower.
And that's why at gas stations, sometimes I hate the ones that ask you to enter in your zip code along with scanning it, because I believe that allows them to get a better rate. Is that right?
Yeah, it does. That's level 2 and level 3. So level 2 and 3, actually, when you pass through the zip code, actually it gets you to a lower. It upgrades you to a lower transaction rate. So all of those. So first of all, that's the card brand fees.
Yeah.
Very little you can do about those. You can't negotiate those with your payment provider. They are what they are. You can do things with them, and there's low cost routing that you can do. That's overcomplicating this example. And then you have what you give your payment partner, whoever they are, and you're going to be giving your payment partner whatever deal you negotiate with. And then what's left of that is your take rate. And that's the 25 to the 80 basis points. And so literally all I was doing was I was taking the total value, multiplying by 80 basis points. And that's your net take rate, because that is what you are going to recognize on your P&L. And most of the businesses that I work with, they recognize, they treat it net, which means that right up at the top of the P&L, the software line is X dollars. And then right underneath that is the payment revenue. And that payment revenue is the net take rate, is that number that I just told you.
That sounds pretty margin accretive.
It's pretty cool. And what's even better than that is that, let's say 3 years, 5 years time, you've grown. You start out doing 100 million, and then you've grown it. Now you're doing 1 billion. Now you're doing 2 billion. And then you go to your payment provider and say, or you run an RFP and you say, guys, you know what? I'm not getting a good deal considering the volumes that I'm doing. And so they halve your take rate just for the purposes of this example. Well, all of a sudden, you're not lowering costs. You're actually increasing your revenue. So actually, that increase that they've given you, or the reduction in their costs, is reflected as an increase in the revenue on your P&L. So it's incredibly accretive.
It sounds like with a lot of these PayFacs, like I know you just said it doesn't sound big, but like that all drops to your bottom line if you set it up right.
Oh, it does. And as I said, I'm working with companies that it's making up 30, 35, 40%. In one case, it's like 46% of overall revenue this year and growing in a business that's already growing. And so it's incredibly lucrative, but I don't want to just focus on the revenue expansion. And of course, that's incredibly important and a big driver. But it is the other things that I think we see that makes it attractive. And I'm talking about the way that obviously increases gross revenue retention, increases net revenue retention, decreases churn in certain areas. And it's a better user experience. So customers are actually getting a better user experience from your platform by doing that. And I think that is an often overlooked area that is a reason to do it. I've worked with companies that have looked at a bit of their business and they have higher churn in bit of their business. So they've actually had an intentional program to actually embed payments there. And they've seen a significant reduction in churn and higher CSAT in that segment because the customer is extracting the full value. So it is the revenue. The revenue is great, but there is value both for the company and the customers of those companies. And I think that's very important as well. If people just fixate on the revenue, sometimes they just look at it and say, right, well, if it's just the revenue, then I just need to get a killer deal with a payment provider. No, you actually have to do the work and embed the solution in a way that actually creates value in the process, whatever that looks like for your business.
Do the NPS scores generally go up after some of the companies you've worked with integrate payments?
It's a great question, and I haven't done that yet. I've actually never segmented out NPS by payments and non-payments. So actually, that's probably something I should do.
Well, I guess actually where the rubber hits the road, better than NPS, I think that all comes through in your net dollar retention rate. And usually the NDRs are off the charts for payments companies.
Yeah, that's right. I think, as you say, the results speak for themselves.
You said how over time companies can creep up the percentage of their revenue that are on payments. We had Tony Bohr, CFO of Blackbot, on the pod, and he was saying, yes. I think it's basically like half their business now.
Yeah,
they're publicly traded. I could look, but it's big.
Yeah, so full disclosure, I used to work for Blackbot. When I sold my business, I ran international for Blackbot. I was VP of international for several years down there. So I love the sector. I know the business well, although I don't know Tony personally. But yeah, it's a very, very big business for Blackbot, and it makes perfect sense why it would be. I mean, the nonprofits, they need to process donations, and so that's where they would go for it.
Should I think about payments as training wheels, Andrew? Where can you go after that?
That's the exciting thing right now. So a lot of my time is spent, we're talking to companies and just doing sort of embedded payments. How do we optimize payments? Should we be in it? How do we get better? How do we scale it? How do we operationalize it at scale? But the next phase of this is, we call it earning the right. Once you've earned the right in payments, it's like, right, well, now you have company that are they're processing their transactions, they're receiving settlements from you. They've earned the right. They've come to you and they trust you for that. Well, then now there's embedded financials like lending. And so a lot of these same companies that you're using for payment integrations and payment processing are now launching capital lending solutions. And so they'll just go through, they don't do like checks. They don't ask you for like 25 pages and a pint of blood closest to the heart. They don't do any of that. They basically look at your last 3 months processing or 6 months processing, and they go, okay, based on that, we're going to lend you insert number here. And it could be 10,000, 25,000, 50,000, depends on what it is. And you can just literally, in an embedded fashion, just go click, yes, I'd like to borrow that. And the next day you'll get that money in your bank account. And then they'll just take that amount of money that is owed on that. And it's usually a fixed percentage of the rate. It's not like an evergreen kind of ARR type thing. It's an APR type thing. It's a fixed percentage. And whether or not you pay it back in a month, 6 months, or whatever it is, average is like, let's call it 8-9 months, you're paying that fee. And they'll just deduct it from the proceeds of your processing every single month. So it's a very, very good option, especially if you're in the SMB space, especially if you're working with customers that need working capital for whatever reason. That's another thing to do. And then, of course, that makes the most sense next. But then there's a whole bunch of things. There's virtual bank accounts. There's all of these banking as a service solutions. There's embedded insurance now. There's even embedded loyalty programs that are coming up. So
can you actually touch on a couple of those?
Yeah, sure. So let's talk about the banking as a solution. So let's say you're processing payments for one of your customers. They then want a small business loan. And so you lend them the money. Then you can set up a virtual bank account for them. And say, right, well, now you've got a small business, we'll actually just set up a virtual bank account for you. And then you can use that. And if you want, then why don't we just give you virtual card issuing? So Now what you can do is do virtual card issuing and use that as an expense management. So you can either pay vendors with it, or you can give it to your employees to actually manage how they manage their expenses. And so now you're getting to the AP world as opposed to the AR world of payments. So there are some companies that are doing some really, really cool stuff there. I'm not involved in this one, by the way, but I heard this story and I thought it was super cool, which is gig work. And especially if you talk about sort of, somebody that is working in part-time in a fast food restaurant, well, they get called in to do a shift. It's last minute. You don't they don't want you to run it through payroll and then for you to then get their money in like a month or so. So they're just spinning up a bank account, spinning up a virtual card, loading up the money that they're for their shift on that virtual card, and then they literally have it at the end of their shift. And so I just thought that was a really cool use case for that kind of model.
That's such a game changer. I think Toast is a company that started doing that in the restaurant industry, because they started with processing the payments at your table, but then they said, we have access to, deliver a service to the employees here too. So they could give you like, it's not a gift card, but I guess they're giving you like a preloaded debit card to pay you.
Yeah. That's right. Yeah, you're right. It's a debit card. It's not a credit card, but yeah, it is. And those accounts payable solutions embedded in an integrated are just incredibly useful. And of course, I've missed one, which is payroll, and more of companies that I'm involved in embedded payroll. Most SMBs, they're running payroll. They have payroll to manage. And so if they're in a practice management solution, then why wouldn't they use that again to run payroll? So all of these solutions, and they're not right for everyone, but they're incredibly valuable. And at the moment, most of what I'm seeing is that people are building it on payments. That doesn't mean, of course, that you have to do payments. There are many of these solutions that if you don't have the business of running payments in your system, then you could just bypass that and look at an embedded accounts payable solution or embedded issuing solution or insurance solution. There's no reason why you don't, but most of the companies, because I'm a payments, if you're a hammer, everything's a nail, and I'm a payment hammer, and that's kind of where we start.
Yeah. When we were at PartsTech, and that's how we met, you were nice enough to give me some advice when we were considering going into payments. We found that we actually weren't the best position to offer payments to the shop, because they were also using a shop management system, which helped with the front of the house and taking orders and saying, Jim's bringing in his car and it needs this to be done. We were just the procurement application to buy the parts for Jim's car. And so the shop management system is in a much better spot to win the strategic high ground for payments there. But then what we noticed is we were actually in a pretty good position to be kind of the payments between the garage who had to order the parts from a supplier, so the middleman. Right. So we were well positioned there. Somebody said, well, if we got that, what would be the next jumping off point? So we're just trying to play this forward of what the other TAMs are. And we said, well, every garage, they need a lift, don't they? Could we loan the small business money for a lift? But then what we realized was they buy all this stuff through Snap-on and these big tool manufacturers. They were better positioned than we were for that. And then I'll shut up after this. The last example that we tried to play through in terms of what would be a good direction to go in here was, let's say a landscaper brings in his car, needs to get it fixed. He needs a new $14,000 engine. Landscaper probably doesn't have that money. Could we offer a loan to the landscaper on the other side of the counter who's purchasing it? But the conclusion we came to was, landscaper doesn't know who the hell PartsTech is because we're invisible on the back end. So I just wanted to give a mental model of how we went through the different options potentially.
That is a fantastic, and I remember this in our conversations, is that that's the impressive thing about the thought process that you went through that many people don't. They just go, no, payments, let's do payments, let's just do that, let's just deploy it. And you didn't. You had a very thoughtful process and model that you went through. Did you end up doing anything in that area, or did you work out that at that time that didn't make sense, that investment didn't make sense?
We luckily got acquired and sold the dream of that before we had to actually do it. But it was kind of sobering though, because we wanted to jump headfirst into payments, but we were the person on the other side of the table, we don't have a relationship with them. We're actually disintermediated by the shop management system. And so we started to think, Andrew, well, maybe we can't do anything with payments, but it was more we just had to have a different starting point within the ecosystem.
That makes sense. And there are a lot of companies out there that just they're not suited to it. But if there is an attraction of expansion revenue, an attraction of something that is going to decrease churn, something that is, then absolutely, your audience, they need to go through that mental mapping model, because I think that is the way to do it. And if they don't understand payments, then I go out and find specialists, find somebody that does understand the embedded financial services world who can help you with that model.
That's a great tee up, because I want to talk about, if you want to bring this in-house, this can't be a hobby, right?
So I don't believe so. There are many companies out there that have done a good job, building a payments business, without a VP of payments, head of payments. But they, almost all of them actually have somebody that wakes up every day and thinking about the product itself and deploying the product and what to do with it. So I honestly think that if you're doing this mental mapping and if you actually work out this business, if you've got 10,000 software customers, and let's just say you assume that 50 to 60% of them can be attached and processing activated over time, and that equals X amount of gross processing volume, and you can glean 60 to 80 basis points. If those numbers map out, then my recommendation would be then invest in it and invest in somebody who has that number and who owns that number and that's on their comp sheet. That would be my advice. But I also realize that that's not always possible. And so, a lot of the conversations I have are just like, well, how do you get started? How do you actually, how do you do a test? How do you test the assumptions that you made in the process? And then once you've done that, then how do you go to the next step? And then what does that investment look like? Is it a payment product manager? Is it a director of payment operations? Is it a VP of payments?
I think what I'm getting at here is it sounds like running a payments function is different than running like a traditional software function.
Yeah, I mean, it is. Payments operates differently. It is, I've had conversations in the last couple of weeks, which is how payments works. It's treated like recurring revenue because for all intents and purposes, it is a recurring revenue.
Yeah.
But it doesn't act like ARR. It doesn't act like, and so, there's seasonality in it. So even how you look at payments from a financial perspective is different. But yeah, it is a different business. Once you landed a software company, there are so many things that you have to do there. Those functions are different than when you land an integrated payments merchant. So it is fundamentally different. And the landscape of people that understand both is quite small because it's such a new business. It's literally, it is last, 15, 20 years, it's become a thing. So it is, in my opinion, it operates differently. That's not a deal breaker, but it has to have buy-in at the top. This is not I say this, I think you asked a while back, how do I think about it? The last thing I think about payments is a feature. It's not a feature. It's not like something you just add to the roadmap and say, no, we got payments. It's going to be released in Q3. Good. Now, what else have we got going on? It's not like that. It has to be treated like the overall solution. It has to be from a go-to-market standpoint all the way. So it's product, it's go-to-market, it's customer service, it's finance. It's a truly cross-functional team sport, however you want to say it.
And two things I'd flag for the finance people who are listening is one, it's forecasted very differently than SaaS revenue is.
Yeah.
And then two, you have to hire a different type of salesperson. I'm not sure there are many unicorns out there who are great at selling both like an enterprise SaaS product and also the payments product.
Yeah, that's right. And in an ideal world, we talk a lot about like comp and incentives and how do you do it? And so we try, in a perfect world, we try to do everything in the product. We try not to have payment salespeople. If you've actually got it perfect, we don't live in a perfect world, then actually it's onboarded almost like a PLG motion. You don't actually have to go back and sell it. Now, it doesn't always work that way. Most software companies have already got an install base. They've always got a client base, I should say. And so even if they started today and they had 100% attached from day one on all of the net new, well, they've still got 5,000, 10,000 customers that aren't using it. So there's always going to be an outbound function there, whether that's marketing, whether that's sales. But for me, low-hanging fruit is always net new. It's easier to attach a payment customer to a net new software customer than it is to go back and try to switch somebody that is using something else.
Maybe gearing towards a close here, if there are people out there who want to say like, who's done a great job at this? Are there any companies that are aspirational comps that they can research?
Yeah, so I mean, obviously, a lot of the companies that are doing this are privately held, so that's difficult. I think there's a lot of stuff out there. MindBody is a great one. Everyone talking about MindBody. It was like one of the first ones out there. There's quite a lot of information about that. Publicly traded companies. Blackboard's a good example. Toast is a good example. So I would say, they're the publicly available ones that are out there. Also, there's like a bunch of studies done by companies, organizations like Flagship, which they specialize in, they're a sort of boutique M&A advisory firm. They specialize in payments. They do some fantastic research. It's just on the website. BCG have done some really interesting stuff as well. So there's a lot of publicly available research out there at a very high level, both about payments and financial services. And then there are like publicly traded companies. I mean, even look at Shopify. Shopify is probably is one of the best examples if you look at how their revenue is split up by payments.
One last question for you. What's the first question someone should ask when they get into payments? And actually, is there like a question that everybody asks you that's the wrong question when they get started?
I'll start there. The question that I get asked that is like the wrong question, which is, which payment provider should I use?
I think I asked you that.
I don't remember that. It's not where you start. That's literally, it is probably, is it important? 100% it's important. But it's maybe the third or fourth question or the fifth question. It's not where you start. I think the question you have to start is payments, do we have the right to win in payments? Is the first question. And then the second is, do we have the appetite and capacity to invest to win in payments? They're the questions that people should be asking before they start.
Andrew, this is brilliant. Thanks for carving out time for us. I really appreciate it, man.
No, it's absolutely my pleasure. You know me, just get me talking about payments and I can't stop. So appreciate the invite and the opportunities. And always nice to see you, man.
Run the Numbers is a mostly LLC production. Yelling an intro by Fat Joe. Artwork by some AI thingamajig. Podcast and video editing is done by Cleancast at cleancast.io. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog too much ice cream and has a history of net operating losses, LOL. If you like this podcast, please hit subscribe. It would mean a lot to me. And also check out mostlymetrics.com. That's my newsletter where I explore business models and financial metrics. Thanks for riding with me. Share this with your friends. Peace.